Welcome to Industry Focus, the podcast that dives into a different sector of the stock market every day. Today is Thursday, June 6th, and we're discussing offshore drillers. I'm your host, Nick Sciple, and today I'm joined by Motley Fool contributor Jason Hall via Skype. How's it going, Jason?
I'm very good. I ran a 10K over this past weekend and set a personal best. Came in below 9-minute miles, so I was pretty happy with that. Feeling good.
Nice.
Feeling good. For 42, I'm happy.
Nice. It was my girlfriend's birthday over the weekend. We went out to dinner, spent some time in the city, went to the new Spy Museum, checked those sorts of things out. It was a good time. So we had some other interesting news over the weekend. Jason, we'll just hit this off the top of the show. The SEC has changed their regulations now to allow alcohol sales in football stadiums. We both graduated from SEC schools. What has been your reaction to this huge change?
So I think it's important to note that since this is primarily an investing podcast, in this case, we're referring to the Southeastern Conference.
Yes.
The dominant football conference and kind of the dominant basketball conference to a certain extent in terms of overall talent. So I think it's really interesting, right? Because, most of these schools have had, the ability for like the super wealthy donors who have their little private boxes, they can bring in their own alcohol anyway. But the thing is, I don't think most of the schools are just they're gonna throw in taps and start having general alcohol sales. I don't think that's gonna happen. I just, we'll see, but I don't know. It's another source of money, right? They can get more money to fund their men's diving programs by selling alcohol and generating extra revenue, right? Is that the idea?
Yeah, I guess that's the vibe. I mean, you think of it, for football, I feel like folks are going to go to the football games no matter what. And we already have, donors. I know at the University of Alabama, we have donors. They can, pay a big amount of money for club seats and they can bring their own in. But, this change has been talked about for a while. And it's kind of come in place. It is interesting, at Georgia, you see some of the money generating the moves they've made. They're going to charge folks $25,000 for the privilege to purchase alcohol at these games in a place where you cannot see the field. What is your thoughts on that $25,000 cover charge for 6 or 7 home games a year?
So that $25,000 isn't just for the booze, isn't just for access to that specific area. It's part of getting into a specific group of donors, that they have to be a part of that group of donors. I can't remember the name of it off the top of my head, but basically it's all the money they're using to fund all of their big capital investments. Like they're building a new tennis facility. They built a new end zone facility with a new locker rooms and like a new visitors area for recruiting. There's a few people that are going to do it, but no, I think it's dumb. I really do. There's been a lot of backlash from both your regular Joes like you and me that don't just have an extra $25,000 to throw at their alma mater, just to get a bumper sticker for that specific little alumni group or whatever. But also from the people that are contributing at that level, saying, "Hey, we're getting thrown under the bus by everybody else for this thing that we weren't even a part of, that we also kind of think is dumb." So I don't know. It comes across as kind of, like they're pretty out of touch with what the alumni and the fans actually want. So, what do you do? Yeah,
we'll see how things play out. It's getting that little bit of nugget that makes it feel like college football season is coming up. I think we're under 100 days until the season. Fun to have a little bit of discussion. But let's now move on to our main topic for the day. And as I said off the top of the show, it's going to be offshore drillers. When it just gives you some numbers for some context on the size of this industry. About 37% of global oil production comes offshore, about 28% of global gas supplies. This is an industry that's really kind of been lost in the woods a little for the past few years since oil prices declined in 2014. But it looks like there are some signs things are going to tick back up. Jason, just kind of 10,000 foot view. What are we seeing today in the offshore market, and how have things evolved over the past few years since oil price decline?
Yeah, so if we go back to 2014, that's oil prices were still well over $100 at the middle of the year. And I think that was the all-time CapEx peak, right, for E&Ps was 2014. And of course, oil prices started falling in the second half of the year. fell sharply through pretty much all of 2015. By 2016, early 2016, there was, the headlines were the death of oil. I think Brent crude was in the high 20s, and West Texas intermediate crude, this is the big U.S. benchmark, I think it hit like $22 a barrel or some just really, really low number. And all along that way, the offshore spending just continued to fall and fall and fall. Because offshore is really expensive to develop. Oil companies' cash flows were getting slammed because oil prices continued to fall, and they had to cut somewhere. And offshore was one of the biggest places they got cut. I think last year we still saw a continued little bit of a decline by the major E&Ps offshore, but spending overall has started to really recover this year. We're still well less than, I think about half where we were in 2014 in terms of that offshore spending, but it is starting to recover. And I think a big thing that's happened too over that time is the drillers that we're going to talk about. The industry has gone through a ton of turmoil. There's been a lot of scrapping of these old rigs that just weren't cost competitive at lower prices, rigs that couldn't operate in the kind of environments where oil producers want to develop resources. And there's been a ton of fleets acquiring one another and a lot of merger and acquisition activity that's happened. So from a fundamentals perspective, the industry is a lot healthier than where it was. The trajectory looks right in terms of spending does continue to increase by the producers. But if you were to look at the stock prices, you would think that this is an industry that they're just, they're going to ask the last guy to turn off the lights on the way out the door. I mean, it just seems so. It's really ugly if you've invested in the sector at all over the past 4 or 5 years.
Sure. And this is a sector that is traditionally very cyclical. And when you have a cycle that was particularly rough in these past few years, when you had oil on the high end got up, $100, $150, a barrel, and then it plummeted all the way down to the 20s, that really left a lot of producers in a situation where they were unsure about the future of oil prices. And as you mentioned, when you invest in an offshore, oil rig, it's going to take several years to go from your initial input of capital to getting money out on the back end. And if you don't know what oil prices are going to be on that back end, it's really tough to make that allocation decision. However, over the past several years, we've seen oil prices seemingly stabilize in this mid-50s to $60 range. And we've seen some break-even levels. As you mentioned, we've get some new investment in new rigs, really modernizing our fleets. We've seen the break-even levels for offshore come down. Whereas, in 2016, we saw break-evens in the $64 a barrel range, which for a long period of time, you'd have been underwater. There's just no sense making an investment
right
now. We've got some estimates from Rystad Energy saying that break-evens now in this mid-40s to low 40s dollar a barrel range, which in this current pricing environment makes offshore, a profitable investment. Whereas, before prices ticked back up, they may not have been.
Let me give some context on that too. That early 2016 period when you're talking about where it was, in the 60s, you go back a few years before that, it was in the 70s easily. So early 2016, let's say February 2016, their average break even was $64 is what they were saying. Again, I said it. Oil was selling for in the 20s, $20 barrels. So you're looking at, you spend $64 to produce something that you could sell for less than 30, right? That's how ugly things were back in 2016. Fast forward to now, oil's in the 50s. You can sell it, you can produce it in the 40s. So you can make money, right? It's a massive, massive shift in the past 2.5 years, 3 years.
Right. And, as we've seen investment in offshore wane over time, the ability of the global oil market to replenish oil supplies as they come off. So you have a well that, is drilled over time. The production of that well decreases over time. Well, what we've seen as investment dollars into new production have dwindled over time. We've seen the replacement rates continue to come down, which has reached us to a point where we're only really producing or replacing the barrels that come off the market at about a 1-for-1 rate with the new ones that were coming onto the market. So we need new investment to create new supply to continue driving the market forward, and that's why we're seeing this cycle for offshore turning around. On the back half of the show, Jason, we'll talk a little bit about some companies we like specifically. Any last thoughts on this broader market for offshore, though, before we move on?
Yeah, I think it's important to kind of understand the greater context of what's happened that's caused offshore to be so much slower to recover than I think a lot of investors, including myself, initially expected. And one of the big ones is shale, right? And that's primarily on shale, onshore. You think about the Permian Basin in Texas, the Eagle Ford Basin in Texas, and some of the other scoop stack plays. The bottom line is that it costs a little more to produce that oil. But if you're an oil producer and you want to get some kind of return on your cash, and you know what oil is selling for today, and you can produce shale right now at a higher break-even cost, but you can literally start generating cash flow within a few weeks of bringing in of starting drilling a well versus an offshore project, which might take 5 or 10 years to come online. Even if the break-even is lower, in the environment that these guys have dealt with over the past 3 years since oil bottomed in the 20s and has recovered, but been quite volatile, it's a pretty easy decision. If I'm a capital allocator at an oil producer, I'm going to focus on shale right now because the predictability of generating cash returns is really, really powerful. Now, I think that one of the things that's changing is the bigger producers, some of you've got the national oil companies, you've got the Saudis who actually have a pretty large amount of offshore oil. You have some of the African countries that have a lot of offshore oil. They have much larger scale of resources and they can plan long term because their cash flows over time are a little more predictable. So I think that's one of the things that's going to drive offshore in terms of like thinking about the greater context, is that because that oil is still so important, while shale's been kind of the swing, I think the offshore plays, because of the predictability of their long-term cash flows, that's why we're going to continue to see that upswing in investment in offshore.
Yeah. Last thing on shale too, the decline rate on shale is much more significant so you can get that investment out of the well much quicker, but it will pay you dividends over a much shorter period of time. And so this shale kind of movement of continually drilling more wells, inputting more capital can work to a point, but as interest rates move up or as the pricing environment maybe doesn't cooperate, that can be a cycle that is difficult to continue over time, whereas that long tail of offshore provides a little bit more stability and sustainability over a long period of time. Obviously, both of these methods are going to play their roles in the market, but there's no silver bullet that can fix all the problems. Okay, Jason, now let's talk about some of these offshore drillers and what's going on with their businesses. First, let's talk about Transocean. That's ticker RIG. RIG, really easy to remember. Transocean, over the past several years, has really been repositioning and modernizing its fleet, particularly targeting these harsh, ultra-deep water environments for offshore drilling. What can you tell us about Transocean, Jason?
Yeah, I think Transocean's really impressive to look at in terms of where the company was at the peak and how it's managed its way through the downturn. If we go back to the Deepwater Horizon event, Transocean was the operator of the drilling vessel on that event, and that happened a decade or so ago. But the point is that the company managed through that crisis. Things started looking better, and then the next thing you know, you're dealing with the oil crash in 14. And when that happened, the company had a ton of older vessels, had a lot of debt, but it also had a pretty decent cash balance. The company was really quick to cut its dividend back then and start preserving cash, and management did a really good job of scrapping older vessels quickly. And continued to scrap more and more vessels over the past few years. But at the same time, the company did a really, really good job of divesting assets. Like I think it sold Bore Drilling, its entire jackup fleet. That's a pretty recent thing that happened. And then it's made a couple of really big acquisitions to acquire more harsh environment, ultra deep water vessels that are the vessels that are going to be in demand, over the next decade or 2 decades, because that's where the biggest offshore plays that are going to need to be developed are. So I think to me, it's the most impressive company coming through the downturn in terms of repositioning its fleet, managing its balance sheet. Its debt came down. It's come up a little bit after a couple of the recent acquisitions, but it's still a very manageable debt load compared to the value of the assets that it owns, its drilling vessels. The company has a ton of deep connections across the industry in some of the hottest plays with some of the biggest producers. So those are things that really play to its advantage in terms of being able to leverage that fleet and continue generating positive cash flows, as the recovery continues.
Sure. And, if we look out into the future, Transocean has the best backlog in its industry. I believe it's $12.1 billion. They call that out as being 4 times its next largest competitor. We've talked about how they've modernized the fleet to really put their assets in a position where they'll be in demand going into the future. When you see that backlog, is that just evidence that thesis has really played out for the company and set themselves up going forward with lots of contracts available?
Yeah, I think it is. I mean, you have to be a little bit careful with the backlog because you need to understand what the backlog is. What does it mean? Because one backlog that at this size, it's a good number, but you really want to understand what it means in terms of like the day rates that it's able to get from its vessels, and in other words, what is that backlog going to generate in terms of free cash flow, right? So that's an important thing to understand about it. And I think for the most part, this is a company that has done a really good job with that. It's not signing long-term contracts at stupid cheap rates. So there are a good number of its lower day rate contracts are shorter term. Therefore, a couple of wells, or maybe they're for a year or less, or in some cases maybe for a couple of years. So what that means is that management has done a really good job of being disciplined, generating cash flows to cover operating expense as much as it can, but also not handcuff it in this current environment to not be able to participate as rates increase, as we start seeing some tightening in the global fleet of drilling vessels, so that it can really leverage the rates as they go up. So I think in general it's done a good job with its backlog being, it's a big number, but it's also a big number that's not restrictive in terms of what it could generate in terms of profitable day rates going forward.
Right. And if you look at this backlog, it appears as though, the company has legitimate prospects going forward. People are contracting its services. However, you look at the pricing for the company, it's trading at 34% of its tangible book value. Historically, it's traded, maybe about maybe 7 or 8% above that tangible book value. So when you look at what the market is pricing this company, that, it's worth less than even the assets that it carries on its books. Is the market too negative on Transocean and, maybe on the industry more broadly as well?
Yeah, I think so. But you have to be a little bit careful with the book value metric. It's one that I've actually used a lot as kind of a baseline for drillers over the past few years. And so here's why you have to be careful with it. Number one, even a fleet like Transocean's, there's still going to be some scrapping activity going on. So if it carries a rig on its balance sheet for $200 million, but that rig really doesn't, that rig might not necessarily have any economic value if it's 15, 20, 22, 23 years old. If it's sitting in a shipyard somewhere in some kind of an idle status, the company may be better off, instead of paying to maintain it and keep it idle, just go ahead and scrap it, eliminate its operating costs. And if it does that, it has to write off that $200 million in value that it's carrying. And that is a ping off the book value. So part of what you're seeing is that 32% of book value roughly that it's priced at right now is because the market does expect that there's going to be some continued write down of those assets. Frankly, I think Transocean's book value realistically probably should be double the current multiple, maybe even higher. 1 times book value is really not too much to ask for. But you go back to, again, 2014 when oil prices started to fall, these book values fell sharply in the past half decade. All of the offshore drillers have looked really cheap by that metric. Now, if you look at cash flows, it's kind of a different story. Transocean looks a little bit expensive based on its price to cash from operations, which is kind of a good metric for cash profits, kind of like a good proxy for that. But that's partly because of some timing things. I just acquired Ocean Rig, late last year. A lot of the vessels that I acquired from Ocean Rig were not under contract, which made it really a prime opportunity to buy those vessels. but its cash flows have taken a bit of a hit the past quarter or so because of that, and that could continue. So you kind of what I'm watching with Transocean right now is I want to see how quickly they can integrate that fleet, drive out any costs that they can, and then start putting those vessels back to work so they're generating cash flows. I think it could take some time to do that. So I think on balance, the risk reward, I think you have to be willing to look. If you buy shares right now, you have to be willing to sit on them, sit on your hands for at least 3 years, 2 or 3 years, to really let the market continue to turn and to continue to improve before you're necessarily going to see those book values start to really recover. But I think there's a tremendous amount of upside in the valuations that Transocean trades at today.
Sure. And last thing before we move on to other companies, when I've looked at several of these as we prepared for this episode, you look at Transocean's fleet, their exposure to these deep water in-demand industries. Would you say of the companies we're going to look at today that Transocean is probably best in class when it comes to offshore drillers? If you need to buy something in this space, this would be at the very top of the list?
Yeah, I think so. I think this is definitely the one that's when you're talking about equities, there's always a risk of permanent capital loss of some level. But this is a company with close to $2 billion in cash. It doesn't have any near-term debt maturities that really put it at any risk because this is a very capital-intensive industry. These companies almost always carry a significant amount of debt, so its ability to manage that debt is important. But between its general cash liquidity, access to tap some revolving credit, it has tons of capital available to it, and it should swing back to positive cash flow, I would imagine, here sometime in the next couple of quarters. So I think this is definitely the one that has the least amount of risk and a pretty decent amount of upside from here. Yeah, for sure.
Sure. So moving on, we're going to talk about EnscoRowan, ticker ESV. When you look at their fleet, it differs somewhat from what you're looking at from Transocean. They're much more tied to the jackup type rig than Transocean is, more focused on the deep water. Can you talk about when you look at those differences in fleets, what that means from the company from an operational point of view, and what they may be exposed to that Transocean is not?
Yeah, so it's an interesting story with EnscoRowan. So if you go back to 2017, Ensco and Atwood Oceanics merged, right? So Ensco had a little bit stronger financial profile. It merged with Atwood Oceanics. Atwood had a great small fleet of really high spec, primarily floaters. So that's semi-submersible and floating drill ships. I didn't have a ton of backlogs. When those two companies merged, there was a lot of financial strength that came out of it. But again, the offshore market was just really, really slow to bounce back. So the decision was made to merge with Rowan just very recently. This closed, actually it closed after the first, I think it closed in April. And Rowan's strength is jackups. So that's where this big fleet of jackups comes with. Is Rowan has a very large fleet of those, has a really solid backlog, and that's where that joint venture with Saudi Aramco comes into play. And so it's a really interesting now hybrid because you get Rowan's strength on the jackup side and this massive customer with the joint venture with Aramco. And then from the Ensco legacy side, it actually still has a pretty focused fleet of floaters, really, especially semi-submersibles that can operate in harsh environments. And the expectation is that the harsh environment semi-submersibles is going to be one of the stronger day rate growth, kind of market tightening, high demand segments of the offshore market over the next 5 years. So I think it's a combination of a pretty predictable amount of cash flow that it should get from the Rowan side of the business that it acquired, and then opportunity to really grow its cash flows from the harsh environment drilling and production that should be really starting to grow over the next 4 or 5 years. It's another company that's got a really good liquidity situation. They just released a presentation that kind of broke down some of their pro forma information because the financials that the companies both reported for Q1, it was before the merger, so they were separate financials. But it's got about $1.5 billion in cash and short-term investments, which is really strong. Again, doesn't have any real near-term maturities in terms of its debt. So over the next 4 or 5 years, its capital situation should remain pretty good. It's much smaller than Transocean, but again, it doesn't have anywhere near the backlog. And a big part of that is because those jackup vessels just don't get the kind of day rates that you do from the floaters that are such a big part of Transocean's backlog. But again, I really like it in terms of a little bit smaller player, really good opportunity for upside. The book value is a little bit, if you look at a lot of the book values in different, screeners that you might use out there, you see it, 20 to 25% book value. I don't know how accurate that is. And until we see consolidated financials, it's probably trading a little bit closer to the same kind of valuation that you're seeing from Transocean. But I like Ensco a lot. I've actually bought shares somewhat recently in RIG and Ensco both.
Okay. Yeah. So are you more bullish then on the ultra deep water, harsher rigs than you are on the jackups? And does that exposure to jackups maybe make Ensco a little bit less attractive, or is that presence with Aramco really make it a special case there that they have such a powerful client with them, buying up their supply?
Yeah, I think it's a good situation. I think that because in general, a heavy jackup fleet isn't necessarily the best situation to be in. But yeah, the Aramco relationship, that joint venture, is really good. And a lot of its jackups are newer, and it has a program to buy a lot more newer jackups that are going to drive down those costs. And you can buy a jackup for, I don't know, $60-80 million. You want to buy a semi-submersible, you're going to spend, triple that, easily. You buy a drill ship, you can spend $500 million. So these are very, those vessels are very, very expensive. Takes a lot of capital, takes a lot of debt. Debt means leverage, interest expense, all that kind of stuff. And the market's going to start recovering. So I guess the best way to describe it is, I like the jackup fleet because of that relationship, because it is a predictable cash flow source that should continue to pay off. But you also have some upside because it does have a nice smaller fleet of high spec vessels in the area that I think we're going to see a lot of demand growth, and is probably the most susceptible to tightening in demand, which is good for day rates, which is good for profits for a company like EnscoRowan.
Awesome. Going to be a company to continue to follow as they absorb this acquisition, come together, and you can see kind of how the financials of the combined company shake out. Last company we're going to talk about today is Seadrill. They also have had, I guess you could call it a transaction. They emerged from bankruptcy in July of last year. So equity holders that were holding prior to that point were essentially wiped out, lost 98% of the equity value. However, since they've emerged, what are we seeing from Seadrill, Jason? Is there any signs that there's some light at the end of the tunnel after they've emerged from bankruptcy?
So yeah, it's in previous shows, myself and Tyler Crow have spoke with you about there's a lot of emotion that we still have with Seadrill. I was fortunate that I sold a pretty substantial amount of my investment in the company about 3 years ago. So, but I did hold some, and I've lost 98% of its value. I sold right before the bankruptcy was official, when it was pennies on the dollar, and just kind of washed my hands and walked away and decided I just wanted to sit back and watch. And essentially what you have is a company with a great fleet, has a fantastic fleet of I think it's all floating vessels. I don't know if there's any that are more than 10 years old. So it's a high specification fleet. It has a smaller backlog, and it doesn't have a ton of debt that it really has to worry about in terms of near-term maturities. It's working through some really high interest debt that it's trying to get off of its balance sheet and get it and repurchase. But it's really struggled to generate cash flows that I think investors should be looking for right now. It's burned through a ton of operating cash since emerging from bankruptcy. I think year ago quarter, I think it burned $180 million of cash flow. It did generate positive cash flow at the end of 2018, $33 million in positive cash flow. So that's a good sign. But frankly, you had a company come out of bankruptcy, and on the conference call, this last conference call, one of the executives was talking about potentially selling off assets, which leads me to believe that the company did not really do a very good job of emerging from bankruptcy healthy and whole. Yep. So it's one that I continue to watch because the potential of its fleet seems to be pretty good, but I'm not convinced that the company's where it needs to be. I think I want to see more recovery in the offshore market before I would really be willing to give them a single penny of my money at this point.
Yeah, one thing I saw, I was reading through their most recent earnings conference call, and I saw this line from the CEO. I kind of get your question on it. He said that our focus is on backlog quality over backlog quantity, which means the moment we're saying no to as much work as we're saying yes to. What are your thoughts on that, given a company that is showing some problems when it comes to keeping their liquidity up? If they have to sell off some assets, they're having some cash issues. What are your thoughts on them kind of turning away business that they could have under these circumstances?
Yeah, no, I think in general, conceptually, that's probably the right general move in this market, because one of the things that has happened that as you've started to see day rates improve is we had to go through a ton of consolidation. We had to see a bunch of guys go out of business because day rates had gotten stupid cheap because people were just saying yes to anything to generate any cash flows that they could. And the balance of leverage shifted completely to the side of the producers. So there does need to be some discipline where, taking a day rate and what this is Carl Trawl, right? The CEO you're talking about?
Dibowitz, Anton.
Anton Dibowitz. Okay, the CFO. I believe he's actually leaving the company too. But the thing that's important is the contracts they're saying no to is when a producer throws out a 3-year contract that's cash flow break even for a rig, for example. That's if I'm in a financial situation as a driller, an offshore driller, where I can say no to that contract, I absolutely would say no to it, because a year from now, 2 years from now, there's a good chance that day rates are going to be 25% higher for that same vessel. So by saying no, you have the potential to help continue to push the tightening of the supply in that market to push day rates up. And it's a little bit of short-term pain that should generate long-term gain overall for the industry. When it comes to Seadrill, I'm just not convinced that they're on balance, that they're really leveraging their assets in the best way. So from an industry perspective, I love that they're saying that. Again, I'm just not sure how much truth to really leveraging their assets in the best way is going on there.
Yeah, something to continue to follow. Again, a company that's less than a year out from bankruptcy is still trying to find its way as apparent by thinking about continuing to sell some more assets. Jason, before we go away, just for folks who want to get involved and maybe buy one or two of these companies and continue to track the offshore drilling industry over time, what are the metrics folks should really be paying attention to, whether it's an individual company metric or a broad industry metric, as they follow this investment over time?
Yeah, so there's a couple of metrics that the companies will talk about that are important. So one is the utilization rate, and that is the percentage of available revenue producing days for their entire fleet. And then those vessels are actually, in other words, the percentage that their vessels are actually working. So there's another one that they use. It's called economic utilization. Now the difference is really important, because the utilization rates for these guys are going to be anywhere from the mid 50s to the low 70%. The higher that number is, the better, because it means they're generating more cash. So the economic utilization is a very different animal, because that is the percentage of working available days that vessels that are actually under a contract are working. Now, it's an important metric because it kind of tells you, it's like a cash flow efficiency metric. How much are they wringing out of every vessel that's actually under a contract? but it doesn't include the vessels that they don't have under contract. So it's really important that you understand that both their actual utilization rate for the entire fleet and their economic utilization rate, right? So that's important to know. You also want to look at the two metrics from their balance sheet. You want to understand what is their available liquidity from a combination of cash and short-term investments that they can tap essentially immediately. Any debt instruments they have access to, like a revolving credit that they might be able to tap for opportunistic acquisitions or anything that they might be able to use it for like that. And also on the backside of the balance sheet, looking at their liabilities, understanding not just how much debt they have, but any near-term maturities that they're going to have to deal with, that they're going to have to come up with the capital to pay off, or that they're going to have to figure out how to refinance, which it can be a little bit harder right now. Now, again, on the operating side, I think an important one to look at is operating cash flow. If you think about GAAP, generally acceptable accounting practices, net income, earnings, there can be a ton of non-cash stuff in there, especially with all of the acquisitions and mergers and fleet scrapping and all of the things that are happening. A lot of those things are non-cash. So the GAAP net income numbers aren't necessarily a great way to understand what's going on the profitability side. Cash from operations is a really good proxy for cash profits. So look at the trends. Don't make a decision based on what happened last quarter or what you're expecting next quarter, but think about the trends over the long term. And those are probably the metrics that I would focus on the most in terms of identifying the quality of the business. And then in terms of valuation, think about price to free cash flow or price to cash from operations over a trailing 12-month period to give you some idea, and then balance that out with the price to tangible book value and kind of split the difference, and kind of somewhere in the middle based on the historical averages is going to give you some idea of the trajectory in terms of, are you getting a decent valuation or not? I think that's basically kind of where I am right now.
Yeah, I think great advice for our listeners. Last thing I'll say is just remember this industry, like a lot of the ones we talk about on this show, is cyclical over time. So like Jason said, one quarter or even a couple of quarters shouldn't determine your investment decision. Just be aware of where you are in the cycle. Right now, it appears we're reaching a cyclical trough and starting to turn back up. So now is a good time to sniff around and kind of kick the tires on some of these companies. And we hope this has been a good introduction to that for investors who want to dive deeper. Thanks so much for coming on the show, Jason, and I look forward to having you on again soon.
Cheers. Thanks so much.
As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed. So don't buy or sell anything based solely on what you hear. Thanks to Austin Morgan for his work behind the glass. For Jason Hall, I'm Nick Sciple. Thanks for listening, and Fool on.